President of StockTradersPress.com, Chris Castaldo, and in Chicago, portfolio manager at Capitalist Pig Asset Management, Jonathan Honig, and welcome to you all. Up first, the NASDAQ 100, the stars and the stinkers. Well, think the NASDAQ's in a rut? We'll take a look at the top 5 stocks in the NASDAQ 100. They have soared in the first half of the year, but are they ready to flame out? And if so, should you buy stocks such as these, the 5 biggest dogs in the tech-dominated index? Jonathan, let's start with you. Should we stick with the winners?
Terry, there have been some winners. That's the most interesting thing. I mean, everyone says the market's so bad, but the statistics you're referencing do show, in fact, yes, there are places to make money. Now, with regard to the NASDAQ 100, the most important thing people need to realize when buying a stock is not necessarily what the stock will do, but what their own position is. My feeling is most people are already way overweight still in the NASDAQ. I might play some of these big losers for a dead cat bounce as a trading buy, but in terms of putting new long-term investment dollars to work, I think you got to be still very cautious on the NASDAQ in general.
Yeah, Rich, would you buy the dogs? I mean, we know it's a tried and true strategy with the Dow, but with the NASDAQ 100, would you buy some of these dogs?
Well, as a value manager, I wouldn't buy any of these because they're expensive. But what I like to see here is that there's actually a semblance of rationality coming back into this marketplace. The top 5, they all actually make money, and 4 of the 5 are actually growing their earnings year over year. And the bottom 5, 4 out of those 5 are losing money and have no prospect of gaining profits over the next few years. So there's a little bit of rationalism coming back, which is very healthy for the market.
Yeah, Chris, would you buy any of these winners? I mean, eBay is trading at 300 times earnings.
I think eBay is one of the first pure internet companies that has actually turned a profit. They're very quick and nimble. They have low costs, no overhead, and their downside is not too bad if a trade goes bad. So I do like them, but I do like them on a bit of a dip at these levels.
You like any of the other winners? How about Microsoft in the news this week?
I think Microsoft had some positive news. They've had a black cloud that has started to dissipate, around them. I think this is going to cause a lot of fund managers, institutions that will actually have to buy back into the stock. I think they're attractive. They could go up towards 100. Could take a little time, but they're an 800-pound gorilla, and I think they belong in everybody's
Yeah, Jonathan, I mean, Microsoft seems to really get stuck in the 80s. Can it push through that?
The stock's up, what, 60% year to date. I think this week's news that the government's antitrust suit the company's not going to be broken up. I think this could be buy the rumor, sell the fact. I think you might look to go short here a little, Microsoft.
Ooh, okay, short Mr. Softy. Up next, layoffs. Thousands of companies are pulling out the axe. Bad news for the people getting the pink slips, but is their pain your gain? Can cost cuts jumpstart a stock? And Rich, we saw that just on Friday with the gear systems.
Yeah, I think unless the company has or is perceived to have a bloated cost structure, or unless the announcement is part of a broader restructuring plan, these are really kind of non-investable events. And it's also important to distinguish the implications of who's doing it. The more cyclical companies like a Bank One and a Merrill, they tend to adjust their workforce in accordance with the ups and downs in the business cycle, so it's not unusual that they're doing it now. On the other hand, the growth companies like a JDS Uniphase and a Nokia, that may be more of an implication that the growth rate is impaired because they're bringing their cost structure down in line with a more reduced growth outlook.
Chris, would you ever buy a stock just because they're cutting jobs?
No, I wouldn't do that. Over the last couple of years, we've seen a lot of companies double or triple their workforce size, only to have them cut down significantly when business started to slow down. So I think a lot of the layoffs that are happening now are just layoffs of new employees that they've added over the last few years.
Jonathan, what about not just layoffs, but these huge write-offs? A lot of people say it sets the stage for strong earnings growth in the months and years ahead.
Yeah, but Terry, how many times have we seen what's bad on Main Street is actually very good on Wall Street? I think in terms of layoffs and write-offs, you have to take it on a stock-by-stock, on a case-by-case basis. Out of the list here of Bank One, Merrill, I like the financials conceptually more than some of the beaten-down tech. But again, JDS Uniphase or even Altera might be good as a short-term counter-trend, dead cat bounce type of play.
Okay, let's move on to some mad money stocks, high-risk, high-reward stocks that could go up big or come down really hard. So bet only with the money you can truly afford to lose. So where's your mad money going, Chris?
I like alternative energy maker Plug Power. The stock is, I think, in a key play. We've had rolling blackouts throughout California. A lot of these utility companies it's going to be a couple of years before they can ramp up their power to meet demand. There's 80 million households in America right now. Everyone is a candidate to be a usage of their product. So I think going forward, the stock is a strong play here. They were $35 a couple of weeks ago. Now they're $20. I think it's a strong buy at these levels.
Yeah, volatile stock, Rich. It had a nice pop this week. It's strengthening its alliance with GE. Would you play any of these stocks? Do you like this one?
This is actually kind of interesting. It's got a first mover advantage play here. The only tough thing about it is that you don't really know how to value the company at this point. But I think it's a pretty interesting situation. It's a mad money pick. It's a little speculative, but it's got some very interesting technology.
Would you touch this stock, Jonathan?
You know, Terry, I don't play or I don't follow, and I don't watch Plug Power, so I'm going to defer on that one.
Okay, well, give us your mad money bet then.
You know, I always seem to get most bullish at the top, Terry, like most people, but the fact is REITs, real estate investment trusts, are kicking butt, hitting, in some cases, new all-time highs as the rest of the market either churns or hits new multi-month lows. The ICF, that's the Cone Steers Realty iShares, this is an exchange-traded fund that follows real estate investment trusts. You know, I talked about EQR and IYR a couple weeks ago on the show, and the fact is that REITs continue to do well, even in the face of a soggy economy.
Yeah.
As a technician, I buy strength, and you got to go with the REITs here. I think this is the second coming of real estate investment trusts.
But you follow market history, Jonathan, and you know that typically real estate lags the overall economy. Aren't we headed for a downturn in prices?
Two things. Past performance, as you know, Terry, not always indicative of future performance. And listen, the bad news is out. People know the real estate market is softening. The fact that these stocks are doing well in spite of that public news, to me, that's a buy signal.
Chris, would you touch this?
I like real estate investment trusts. I'm a big fan of them right now. In a falling interest rate environment, I think they're going to help REITs.
Rich?
I think that I have a more positive market outlook going forward. These are very defensive, so they're good in a tough market. If the market starts to come back, I think you want to move on to other issues.
Okay, your mad money play, not too defensive, but I guess it can't go down too much more. WorldCom, why do you like it?
WorldCom, yes. We've been buying some of this recently. It is the tracking stock for the internet backbone, hosting businesses, and the business services of WorldCom. The stock is down from 64 over the last couple of years. It's close to the 14 level. They have a terrific asset base. They have a worldwide sales force that can provide global network services for a wide range of very large companies. Their data, internet, and international business, which make up about 3/4 of their total business, they're growing 15 to 30% per year. Valuation's very good, too. 12 times earnings, 40% discount to the market. I think it's a really great value company. It's got good growth prospects and a great valuation.
Yeah, valuation certainly goes up when a stock goes down 80%. Jonathan, what do you think?
Rich, do you have a price target on this one? I mean, WorldCom was the stock that everyone owned and that everyone wished they hadn't owned a few years ago. I mean, how far can it go from the low teens?
Actually, we think this stock can get back into the mid-20s fairly quickly. And if the market really starts to get more enamored with the growth prospects that this company actually has, and it gets some sponsorship, I think that the valuation will get more in line with where it should be.
All right, that's a wrap for Stock Smarts. We'll be watching what happens to all of that mad money. But up next, there are thousands of mutual funds to choose from. But if you plan to buy just one, which one would it be? It's our mutual fund face-off.